Did Mark Cuban underpay his 2023 taxes by $282 million? I'm going to break down his tweet from today about how he paid a $275.9 million tax payment, how that's roughly $282 million less than what I would expect. I'm going to break down the calculation behind that. I'm going to explain 4 potential reasons why his payment was so significantly less. The 4th reason being most compelling, most interesting, most likely, and frankly, what I would advise my clients to do in a similar situation. So let's do the math. So in 2000, Mark Cuban buys the Mavericks for $285 million. He holds on to it. And then in 2023, he enters into a transaction that was valued at $3.5 billion. He didn't sell his entire stake in the Mavericks. He's reportedly holding on to 27%. That means he sold 73%, again, at a valuation of $3.5 billion. So what does that mean practically from a tax perspective? Well, we've got to calculate the gain, capital gain. Capital gain is going to look at proceeds received, how much went to Mark, minus his basis, minus any selling costs. Well, we don't know the selling costs, so we're just going to have to estimate, but it's probably in the low couple $1 million, roughly. Not a huge enough amount to be material to this calculation. Again, the valuation was $3.5 billion, and he sold 73% of his stake in the Mavericks. So if we take $3.5 billion, the sales price here, times 73%, we get proceeds received. And I'm going to do some rounding here. You can see the actual numbers on the screen. Proceeds received, we're going to call it $2.6 billion. His basis is $208 million. Got to that basis by taking his purchase price is $285 million that he paid for it, times 73%. That means that he has a capital gain, roughly $2.4 billion. This is going to be considered a long-term capital gain, which are going to be the best tax rates for him because he's owned the Mavs for more than a year. And the maximum capital gains rate, federal tax, is 20%. Now, Mark lives in Texas. Texas doesn't have a state income tax, so that keeps things relatively simple. We don't have to factor in federal income tax and state income tax. Just assuming he only has exposure here to federal income tax. So he's going to be responsible for a taxable gain of 20%. If we take the $2.4 billion net gain that he has on his sale of 73% times 20%, we're already at $469 million roughly. And he reportedly paid an estimated payment today somewhere around $275.9 million. So we are considerably above that number already. So this type of taxable gain is also subject to a second tax in addition to long-term capital gains. And that is referred to as the net investment income tax, sometimes also referred to as the Medicare surtax. That's a 3.8% tax on any investment income. This is a gain from an investment. So what we're going to do is we're going to take the $3.3 billion taxable gain. We're going to multiply it by 3.8%. That's going to give us the total net investment income tax of another $89 million. So when we add that to the capital gains tax, now we're looking at a total tax of $558.6 million. Pretty significantly greater than what Mark shared in his tweet. How is that possible? Well, there's 4 possible explanations for this. And again, the 4th reason that we're going to break down in detail is the most interesting and the most likely scenario. Option 1 is he's already made payments. That's the boring option. He already paid $283 million over the course of last year, with the last payment being January 15th. I'm going to call that unlikely for a couple of reasons. One, if he paid that much, he's tweeting today about paying $275.9 million. Why wouldn't he have included the rest of the amount? It doesn't make sense. So I'm going to say that's unlikely. Option number 2 is that he had the sale structured as an installment sale. What that means is that he would have received part of the payment, or roughly half of the payment. Calculate the exact percentage just by taking the $275.9 million that he paid divided by the total. So he received 49.4% of the proceeds in 2023, and he's going to receive the remainder this year over the next couple years, and so he'll recognize the remaining gain coming years. And I think that's unlikely that the entire amount was deferred in installments. One, I don't think that's the way the NBA is working right now, especially with what's going on with the Minnesota Timberwolves transaction. But also, Mark's a business guy. He understands the time value of money, getting cash out. I don't think he's deferring a significant amount to future years. And especially, it was reported that the buyers sold $2 billion worth of stock around the time of this transaction. So maybe some of it was deferred to this year. I doubt that it was as high as 51%. The third scenario is that Mark had losses. Capital losses can be used to offset capital gains. So he would have needed to have pretty significant capital losses. In fact, we can back into that number, capital losses, by taking the difference that we have divided by the total tax rate, which would be the 20% capital gains rate plus the 33.8% Medicare surcharge. And so to get to his number, we would have needed losses of roughly $1.2 billion to offset his taxable gain to get to the number that he paid. I'm going to say that's only likely. Sure, he had some losses. He did something called capital loss harvesting. Again, he's a savvy business guy. I can't imagine he had losses of $1.2 billion to offset gains. So that leaves what I consider to be the most likely scenario, that he took this $1.2 billion difference and he deferred the tax through something called an opportunity zone. Now, this structure was created under the Tax Cuts and Jobs Act, or what you might refer to as the Trump tax cuts. It created this structure that says that if you invest funds into an area that's designated by the government as an opportunity zone, there's areas in every state across the country, you get to do a couple things. One, you get to defer the tax with capital that you rolled in. The current rules are for the 2023 tax year, you get to defer the tax until 2026. So you get 3 years of defer. Additionally, if he holds on to that investment for 10 years, all of the appreciation on that investment, tax-free. Why do I think it's a likely scenario? Because a couple years ago, Mark made a purchase of a ghost town in Texas, about an hour from Dallas, 3 hours from Houston. That purchase is in an area that's designated as an opportunity zone. So he already owns the property there. And also, that is reported that that specific area is not subject to any zoning restrictions. There's been some rumors and suggestions around plans that Mark has about building a new type of community. So he already has the property. It's in an opportunity zone. There's a significant amount of capital gains that he can defer. So I think that's a likely scenario, especially when you get into the math. So let's get into the math. And let's just say that Mark's going to get a basic standard return 12%. Now, is it likely to be higher than that? I think so. But let's just say he's going to get 12%. So after the year one, he's going to get 3 years of deferral before he's going to have any tax. The value of that $1.2 billion that he put into this opportunity zone to defer it is going to be equal to 1 plus 12% rate times the value. So year one, from 1.2 billion to 1.33 billion. Year three, still, we're just assuming that he's going to continue to get this, what would be for someone like Mark, pretty meager rate of return, 12%. Now it's at 1.49 billion. And in year three, total value, again, just a meager 12% return, 1.67 billion. So in 3 years, his appreciation, the money that he put in here to defer, is $481 million. Now, we estimated that he was underpaid by $283 million. So in 3 years' time, that appreciation is now well exceeded. Now, at the end of this time, he would need to pay the $283 million in tax. I'm going to come back to that in a moment. But let's just assume that he's going to hold on to this for 10 years, because then all of the appreciation on what he invested is going to be tax-free. So let's see what the value is in 7 more years, year 10, $3.7 billion. So if he's held on to that for 10 years, it's now worth $3.7 billion. All of that gain, if you were to sell it because it was in an opportunity zone, tax-free. Now, it still had to pay tax that we deferred, tax deferred. It still had to pay it. Remember, that number was $282 million roughly. So his remainder under this scenario, take the 3.7 minus what he needed to pay, $3.4 billion. You might be saying, Dan, well, wait a minute. We need to factor in or reduce the value up here in year 3, tax payment, and project that out. Well, there's Technically, yes. So I'm going to do that math for you in just a moment. Although practically speaking, those funds would need to come separate from what was contributed within the opportunities. Now, practically speaking, he would have needed to pay that. And so we can factor that into the calculation. So let's come back up here. And let's just say year 3, he's got the 1.668 minus the tax payment deferred, $283 million. And so at the end of year 3, he's only up $200 million. And then when we extract, so he's up 198, 200 million. And then when we project that out to year 10, he's still up 3.1 billion. He sells that, it's all tax-free gain. Alternatively, let's say that instead, what actually happened was he paid the tax. He paid the estimated tax, or he's deferred it to this year. He's not getting any rate of return. And so let's look at what he would have had available to invest. The scenario where he's going to pay out the 283 million shortage that we're showing. So net cash he would have had available to invest. So let's just say instead he invested this amount. He's getting that same annual return, 12%. So year 1, let's just look at what is that going to look like in year 10. So at the end of year 10, he's got $2.8 billion. But he didn't put this money into an opportunity zone in this example. So we still have to burden it by both the capital gains tax of 20% plus the net investment income tax of 3.8%. So let's do the math here. Take 2.8 billion times 0.238%. We get $669 million. We take that and we subtract it from the 2.8 billion, and he's left with 2.14 billion. Now, let's take this a little bit further to a more likely scenario, because we assumed 12% rate of return. Look at what happens if we go up here and we change this to something perhaps more realistic, investment like this, 20%. Even that might be underestimate. He's left with $6.3 billion compared to the scenario here, where he's at 4.2, a $2.1 billion. This is why I believe what's actually happened is Mark took part of the transaction, invested it into an opportunity zone. He already owned the property. He's already signaled to the world that he's planning on doing a development there. An hour within Dallas, from Dallas, it's 3 hours from Houston. And that's why I believe that there was a broader plan right here, and it's significant. And that's why understanding the tax rules and using them to your advantage is one of the key ways to exponentially grow your network.